Hi everyone. I'm now recording this for the second time. I wasn't done yet, fortunately. I was only like, I don't know, a third of the way into the recording, but man, these video things are sometimes too much for the old person. All right, you guys, I'm going to walk you through problem 9-41. Number one, because when I walked 4 students through this in office hours yesterday, we had some glitches. We made some errors, and when we tried to correct the errors, it was putting funky amounts in these blanks that should have remained blank, but it was putting amounts in that were huge, and they didn't make sense, and we couldn't make sense of them, and I think it's a software glitch, so I actually lobbed the question over to Pearson, and I'm waiting to hear back. But in the meantime, I decided to walk myself through the problem again to make sure that I didn't get a glitch, because I would hate for you guys to all work through a problem, spend a half an hour on this stupid thing, and then find out that it's not working for you, even though you're like 99.9% sure that you got the answer right, which was the case with us yesterday. So, and the second reason I'm walking you through it is one of the students who was there yesterday asked me to walk him or her through it again. And I'm thinking, because this student is still having issues, maybe a lot of you guys are having issues. What I'm going to do is walk you through the problem, and as I go along, I'm going to explain to you why we're doing what we're doing. The point of this problem is to calculate basis, Katie's basis in this partnership as of year end. And Katie purchases an interest in the KS partnership on January 1 of the current year for $45,000. Now, when she buys a piece of property, which is called a partnership interest, for $45,000 cash, what basis does she receive in that on day one, barring everything else? That's right, she receives a $45,000 basis. She bought some property in exchange for cash, and the fair market value and the basis of the cash is 45, so she receives basis equal to $45,000. Now, let's read on. The partnership uses the calendar year as its tax year end and has $140,000 in recourse liabilities when Katie acquires her interest. The partners share economic risk of loss associated with recourse debt according to their loss percentage. Oh no. I don't know why I keep getting this thing up. And right now I'm gonna go out of here too, so I don't have an issue. Okay, sorry about that, you guys. So where was I? The partners share economic risk of loss associated with recourse debt according to their loss percentage. If you guys look on pages 22 and 23 of chapter 9, you will see a discussion of liabilities of a partnership and how partners share in those liabilities in accordance in terms of what kind of basis they get for those liabilities. And what kind of basis they get for liabilities of the partnership depends upon a couple of things. Number one, what kind of debt is it? Is it recourse debt or non-recourse debt? Number two, is the partner a limited partner or a general partner? And in this case, in requirement A, there's 3 requirements in this. There's 3 fact patterns in this problem, because they're changing the fact pattern so that you'll learn different rules in the chapter, okay? So in the first fact pattern, Katie's basis on they want you to calculate Katie's basis on 1231, assuming that she has a 20% interest in the profits and losses of the partnership. KS in the first requirement is a general partnership, and Katie has not guaranteed partnership debt, nor has she made any special agreements about the partnership debt. Now, we know from the reading that if that's the case, then a general partner receives basis in recourse debt according to their profit percentage. And wait, am I right about that? According to their loss, hold on a sec. They actually receive basis in recourse debt according to their if they're a general partner, according to their loss percentage, because it's based on their risk of economic loss. But they would share in non-recourse liabilities according to their profit ratio. Okay, so in this case, it doesn't really matter because their profit and loss ratios are the same. So they're both 20%. So now what our to do is here in requirement A is to calculate basis on 12/31. So we know that on day one, she buys this partnership interest for $45,000. So she receives basis of $45,000. Then we also know that she gets basis for a share of the liabilities. So that increases her basis. So this person yesterday who was there didn't understand about pluses and minuses. So, basis is a positive thing, right? Don't think about debits and credits. That's not what we're doing here. We're not trying to build a balance sheet or anything. We're trying to do a calculation of her basis. So don't be getting mixed up. I think some of you got mixed up yesterday because you were like, oh, basis of fixed assets is like a debit on the balance sheet. And so I don't understand why basis would be a credit or a plus or whatever. On her personal balance sheet, she will have, if she were to have a personal balance sheet, if Katie were, she would have this thing called investment in KS partnership, and it would be a debit on her balance sheet, right? Because it's an asset. And that debit would get increased, that basis would get increased for all of the positive adjustments to her basis, and it would get decreased for all of the negative adjustments. Now, does that make sense? Hopefully that makes sense if you guys are trying to think of this in a balance sheet perspective. That's how to make sense of it. Okay, so she has $45,000 plus she gets a $28,000 share of the liabilities. How did I get that? I multiplied the $140,000 of recourse liabilities times her 20% interest, so that's $28,000. The reason I had originally, I had 9, and basically I multiplied 45,000 times 20%. I was doing it in a hurry and just did the wrong thing, right? So I knew what my error was there. Then she gets basis for all of the positive amounts, all of the income items coming on her K1, and that's otherwise known as her distributive share of partnership items. So you'll see that some of the partnership items are income, which is the ordinary income, the long-term capital gains, and the muni income. And some of these partnership items are negative, right? They're expense items or loss items, and that's charitable contributions, right? That's an expense item, and interest expense on the muni investment. And that's an expense item. So all we do is we put those in here, and there were drop downs here where I could make choices over here to the left. And so I chose partnership ordinary income, and this is already multiplied out at her 20% amount. You didn't have to, in this problem, you don't have to multiply it out. This isn't the partnership's items. This is her share of the partnership items because it says her distributive share, okay? So 26, the 10 of muni interest income, the 7 of long-term capital gains. Charitable contributions is -8. You can either put that in parens or you can put a minus before the 800. Then the interest expense is a negative, you can put of 2,100. And then there's a decrease in the liabilities. Where do I get this from? I open up this, and this is the liabilities as of the end of the year. So at the beginning of the year, the liabilities were $140,000. At the end of the year, they're 80 plus 30. Notice that at the beginning of the year, there was no non-recourse debt. There was only recourse debt of $140. But at the end of the year, the non-recourse debt has come into being. So at some time during the year, it increased by 30,000 from 0 to 30. So at the beginning of the year, the non-recourse debt was 0. At the end of the year, the non-recourse debt was 30. But we don't care about that because she's a GP. GP's share in both recourse and non-recourse debt. Her profit and loss ratios are the same, so we don't have to worry about multiplying, using the loss ratios to multiply to get her share of the recourse debt and using the profit ratios to multiply to get her share of the non-recourse debt. We don't have to worry about that because it's just 20%, so it's easy. So we just take the 140,000 of liabilities at the beginning of the year and the 110 at the end, and what did that decrease by in total? $30,000. So that decrease in liabilities from the beginning to the end of the year means that we have to reduce her basis by her share of those liabilities that decreased, okay? Because she doesn't have basis in those anymore. They went down. She got positive basis for them at the beginning of the year, but they're not worth 140 anymore. The debt's been paid down and it's only 110 at the end of the year. So we have to reduce her basis by her share of the decrease. So her share of the decrease is 30,000 times 20% or 6,000. And if I total this down, if I foot this, it's 107.1. And I did get the total right. I got the total wrong, but that's because I had 9,000 in here instead of 28. So this is not a glitch. This is correct. Okay, so that's requirement A. Now, requirement B says, how would your answer to Part A change if Katie instead had a 20% interest in the profit percentage, in the profits of the partnership, and a 10% interest in the losses of the partnership? Again, you're supposed to assume that it's a general partnership, yay, so we don't have to worry about that, and all other agreements continue in place. Also assume that the partners share recourse liabilities in accordance with their loss interest percentages. So remember, I was fumbling and looking in the book a few minutes ago on requirement A to figure out if general partners usually share in loss interest percentages or profit. It could change. It could be, the agreement could state something different than what it's saying here in requirement B. But I think normally they would share recourse liabilities in loss percentages, and then they would share in non-recourse debt in profit percentages. That'd be the general rule, and then you can always have special arrangements in the partnership agreement. Okay, so now we have to refigure, do the same thing, the same exercises we did above, but we're now going to have a little tweak to this because of the change in her sharing in the profits and losses of the partnership. That's going to change something. Now, it's not going to change the 45,000. It doesn't change the partnership ordinary income, the long-term capital gains, the muni interest income, the charitable contributions, or the interest expense. All of those are the same in B as they are in A. Okay, those don't change. The only thing that's going to change is her share of liabilities at acquisition of the interest. So the liabilities are still 140,000, but now it tells us in requirement B that we're supposed to assume that partners share recourse liabilities in accordance with their loss interest percentages. And since her loss interest percentage is 10%, now she only gets basis equal to 140,000 times 10% in those recourse liabilities. So 10% of 140 is 14,000. So I had to change that to 14,000. And then my last thing is her decrease in the recourse liabilities. Now, how I come up with this is this. We know that she's going to share in the recourse liabilities according to her loss sharing ratio. So that we know that let's get the liabilities up here again. We know that the liabilities go down from 140,000, the recourse liabilities go down from 140 to 80. So that's a $60,000 decrease. So we have to decrease her basis by her share of that decrease in the recourse debt and her share according to her loss interest ratio. So if it went down by 60,000, if the recourse liabilities went down by 60,000, her share of that decrease is 6,000. So I had to decrease that. Now I'm not done, because now what do I do with the non-recourse debt? Well, the non-recourse debt, I told you a minute ago, according to the book on page 23, it tells you that general partners normally share, they get basis for, in other words, in non-recourse debt according to their interest in the profits of the partnership, their percentage interest in the profits. So she has a 20% interest in the profits. What was the non-recourse debt balance at the beginning of the year? 0. What is it at the end of the year? 30. So there was an increase in the non-recourse debt of 30,000. Her share of that increase is 20% of 30,000, or 6,000. So I had to add something to this line up here, and they gave me an extra line, okay? And by the way, what I got wrong here was I had put increase in recourse. I don't think it was a glitch. I probably just did it quickly and got it wrong, okay? So if you were doing this yourself, you'd be like, oh, I know it's an increase in, something, in some kind of liability, and then you would just try again and put, non-recourse instead of recourse, and you'd get it right. So then you could get full credit. I didn't even bother. I just kept pressing check, check, check. I just kept it in there to be quick. All right, so that comes out to 99.1. Now, our last requirement is this. How would your answer to Part A change if Katie were instead a limited partner? Now she's a limited partner. So if she's a limited partner, what kind of partnership is this now? Can a general partnership have any limited partners? The answer is no. But a limited partnership always has at least one general partner, and then the rest are limited partners, okay? So that's the definition of a limited partner, is there's one or more limited partners in the partnership, and there has to be at least one general partner in a limited partnership, okay? It tells us here that she's a limited partner having a 20% interest in the profits and 10% interest in losses, and that the partnership agreement contains no guarantees or other special arrangements. And it also says if a box is not used in the table, leave it empty, do not select a label or enter a 0. So if you're not going to use one of these rows, like you can see right here, this row's not used, there's just a big blank there. I left that blank because really what's being left blank here, I could have left the top blank, and what I would have left blank in the top is her share of liabilities at acquisition. Now, why is that? It's because of this. She's a limited partner, and I screwed up this in my discussion with you guys yesterday at office hours. I went on and on about how a limited partner gets a share of recourse debt. No, they don't. They don't get any share of recourse debt unless there are special arrangements made in the partnership agreement. And they have to have they have to be at economic risk for that liability, that recourse debt. I want you guys to read the couple of pages, 22 and 23, about liabilities so that you'll understand more how that's, how partners share, how they get basis for liabilities and why. Somebody was asking me why. So it talks a little bit about it on those 2 pages, and be mindful of the little additional comments in the margins, and also they'll have like stop and thinks, and they'll have the other thing that's good is little things in the margin. I think one's called like a tip or something like that. Read those, because those are special little hints that will help you guys. It'll sometimes talk about the technical reasoning behind something. Also read the footnotes at the bottom, because that's the site to either the code or the reg section, or maybe a revenue procedure or a rev ruling, or sometimes a court case that further explains what they're discussing in the body of the text. Okay, so requirement C, I have to do the same thing. My goal is to calculate her ending basis in the partnership interest. I start with 45, that doesn't change. she doesn't get any basis in the recourse debt. So because there's no non-recourse debt at the beginning of the year, there's only recourse debt, she doesn't get any basis at the beginning of the year for the non-recourse debt, okay? Oops, I'm in the wrong. Okay, she doesn't get any basis for that. We move right on to her distributive share of the partnership items. So the $26,000 of ordinary income doesn't change. Interest income doesn't change. Capital gains doesn't change. Charitable contributions doesn't change. That's a negative. Interest expense, that doesn't change. Those are all on. Those will all be showing on her K1. Those are her distributive share of the partnership items. Now, what's going to change here is one thing, and that is she's a limited partner, so she doesn't get any share of the basis for the recourse debt, but she does get basis for the non-recourse debt. And that's just a rule, okay? And you can read about it, as I said. And it says that she shares in the recourse debt according to her profit percentage, sharing percentage. So she has a 20% profit percentage, and we know that the non-recourse debt went from 0 to $30,000 at the end of the year. So her share of that $30,000 increase is 20 times 30 or $6,000. So I put that there, then I re-added this all up, came out to 91.1, and it's a beautiful thing. It all, I actually got requirement C all right. Yay. Okay, now the other thing I want you guys to look at is topic review C9-3. It's called Basis of a Partnership Interest. It's a blue table in your book on page 925 at the bottom, and it's very important because, again, the person who emailed me this morning said, I'm having trouble knowing whether something is an increase or a decrease to basis. And I'm assuming that person had the problem because maybe he or she had not seen this table. So this table is very important. It kind of shows you that a contribution of property results in an increase to basis. You get basis for it. That's your first item of basis. And you take on a basis equal to the basis of the property that you contributed, which is called a substituted basis. So if you contributed a couch that you had tax basis of $1,000 in, then you would get basis in the partnership at day one of $1,000. That's called substituted basis. Plus, you also get basis for any gain that you recognized on contribution of that property. And normally, I told you that under Section 721, there is no gain or loss on contribution of property. It talks about that in the first couple of pages of the book. But when you are contributing property to an investment partnership, which is a special kind of partnership, there are differences, different rules, and it's not a non-taxable event. So I didn't assign you any problems where it talks about an investment partnership, but you can read about that. And then it tells you that for services contributed, the amount of basis is that you get for that is the amount of income that you recognized. In other words, you'll get a W-2 or a 1099 for those services that you gave to the partnership, and whatever the income is that you have to recognize for those services, i.e. whatever's on your W-2 or 1099, is going to be what you get basis for. And plus anything, you might give them services plus some cash. And that might be your original contribution to the partnership is services and cash in exchange for an interest in the partnership, a partnership interest. And so your basis will be the amount of income recognized for the services rendered plus any additional amount contributed in cash or property. And, okay. And then it also tells you that liability impact on basis in this table. And it says you increase basis for increases in the partner's share of partnership liabilities. And you also increase basis. We didn't have to do this in this problem. It wasn't in our fact pattern, but you also increase basis for liabilities of the partnership that are assumed by the partner in his or her individual capacity. So in other words, if you have a liability that's sitting on the partnership's books that are actually assumed by the partner, he's on the hook for them, then he gets basis for that entire debt, not just his partnership share of the debt. And then you decrease basis for decreases in the partner share of liabilities, and you decrease it for liabilities of the partner that are assumed by the partnership. So if there are liabilities of the partner that the partnership ends up assuming, so in other words, the partner gets relieved of debt, doesn't it make sense that you would reduce your basis for that? You got relieved of debt. So the service doesn't make you recognize that relief of debt as income right away, but it does reduce your basis in the partnership interest. So someday when you sell that partnership interest, you will have a higher gain than you would have if you hadn't decreased that basis. Does that make sense? That's why you decrease the basis when you get relieved of debt. And so if you contribute a building to the partnership that had an underlying mortgage, and the partnership, you get relieved of that mortgage in contributing that property because the partnership assumes that mortgage for you, then that's a relief of debt, right? You don't owe that anymore. So that's income to you. That's like, woohoo, I don't ever have to pay back that debt, right? So you're not going to have to pay the piper, i.e. the service right away, the IRS right away, for that relief of debt, which is called cancellation of debt income or COD income, but you are going to have to decrease your basis for it. So someday when you sell that partnership interest, you will have a higher gain on sale of the partnership interest than you would have if you had not had a relief of debt. And then finally, you increase your basis for your share of partnership ordinary income and any other separately stated income and gain items, including tax-exempt income items. You also increase your basis for additional contributions you make during the year. And you also increase it for pre-contribution gain, but we have not gotten to that yet in this problem. But you do need to read on that because I think it's in one of the other problems. And pre-contribution gain is the gain that you would have recognized and had to pay taxes on if you had sold the property that you are contributing to the partnership. So if you contribute a building that you had bought for $1 million, which is now worth $1.2 million, you have a pre-contribution gain of $200,000, and you get basis for that. And later, something's going to happen later with that, and I want you to read up on that. And then you decrease basis for distributions from the partnership to the partner, the partner's share of ordinary loss and separately stated loss and deduction items, and then pre-contribution loss recognized. So make sure that you guys are using this table because it discusses about increase and decreases. They also talk about the increases and decreases to basis in the pages, the prior pages, the pages preceding that table. It talks about share for liabilities. It talks about share and basis for effects of partnership operations. And it talks about beginning basis, how you calculate beginning basis. That's back on 21. So basis for partnership interest is discussed in great detail starting on page 21 and going all the way until page 27. Okay? I hope this helps you guys. Sorry it's so long, but everyone keeps saying they like my videos. So talk to you later. Have a great Sunday. Don't go to Super Bowl parties and then go do my homework, right? Or your homework, because that could be a problem. Try to get the homework done before you have fun today. All right. Talk to you later. Bye.